Okay, let's take a quick look at the TSX as we start this Thursday trading session. We mentioned just a bit cautious out there as investors are trying to assess, yes, earnings, but also the latest economic data in the U.S., which is suggesting a bit of a cooling. We saw that in the jobless claims data. And then for energy investors, and we've already seen some of the TSX energy components under some pressure this morning, we're continuing to see weakness for WTI. We're below 72 U.S., and there's a lot of questions about how the oil story fits in to where these markets are going, where the economy is going. So we thought it'd be great to have Eric Nuttall back, partner and senior portfolio manager at Ninepoint Partners. It's nice to see you.
Always good to be here.
And this has been such an interesting asset class to watch this year because we speak to a lot of folks, including yourself, and you've sort of built a very bullish case for investing in energy over the long term. But the market seems very jittery these days. What's your assessment?
Sentiment right now is awful. You know, everyone is captivated by the idea of, my God, we're heading into recession in the U.S. because of aggressive Fed hikes, maybe even in Europe. And so therefore, if we're heading into recession, surely demand must be weak for oil. Oil price has been falling on that. And then we're in the situation now where price is setting narrative. People go, aha, I told you so. Price is falling, demand must be weak. And we can categorically prove that that is incorrect. We can look at draws and inventories in the United States in April. Usually we draw products. Usually we inject, build heading into the summer season. This year we've drawn. We look at global inventories. They're now just starting to fall. We listen to the refiners who have all just reported their Q1 calls, all pointing to demand growth. And so there's this very strong divergence between what the financial market thinks about the bullishness of oil and what the physical market says. Physical market's very, very tight. And so I use this analogy, like it's like the market's in this tantrum, like my 3-year-old a couple days ago saying, the water in the bathtub is too wet, which is a true story.
Yeah.
And they're in a tizzy. They can't see what's coming. You can't use logic to explain. So what we see coming, literally in the next couple of weeks, even under a recession, is perhaps the largest draws in history from oil inventories. And so you can believe in a recession. You can be bearish on the U.S. because of Fed and weak gasoline demand, all of these things. But the impact of demand growth elsewhere in the world, combined with the OPEC cut, which is now just taking effect, is likely going to lead to the lowest oil inventories in at least 5 years by the end of this year.
Are there similar moments in history where you've seen a disconnect and then ultimately sort of a winning side of the trade?
There have been. And so when you look back in history, historically, the inverse correlation to where inventories go to where price goes has been very, very strong. That broke down about this time last year, just as the concerns about a recession were really taking off. And so I really believe that you're fighting this bearish narrative, even though you've got facts and logic and data on your side. So I think you just need these really, really violent draws from inventory to jolt people from this narrative that everyone's bought into.
Interesting. And most of your investor advice for BNN Bloomberg audience members is through the lens of these different Canadian energy producers. Can you walk us through those investments versus the actual price of oil and what's been happening there?
So if we look at the current oil price, this year's been, not to say a write-off, but we've had this drawdown in oil. Now we have forest fires, which impact Q2 results very, very modestly and such. So I'm really looking to, what can these companies yield on a good run rate at 70, 80, 90, and $100 oil? And so at the current oil price, roughly $70, we see the sector yielding about 11% next year out of free cash flow. That goes up by about 3% with every $10 move. And so at 80, we've got a sector yielding 14%. At 100, it's close to 20%. Our view is the most mispriced energy equities on this planet are Canadian heavy oil names because we can get decades worth of free cash flow for free. We have companies trading at their lowest valuations in history. With their strongest balance sheets in history, we have the sector debt-free, should they so choose, Q2 of next year, generating the most amount of free cash flow, most importantly, pledging that once they hit their ultimate leverage metrics, we will get 75 to 100% of that free cash flow back to us in the form of buybacks and dividends. And so we're seeing companies like Athabasca this morning report. And what did they say? Well, they've just, I think the first time in their history, they're now debt-free. They're using 75% of their free cash flow, and they bought back about $20 million worth of stock in 1 month. That's going to be the theme for the sector going forward.
So in terms of being able to push the validation button, because we're talking about energy, but you can talk about all sorts of arguably value parts of the market, right? Like, there are some people that don't understand why some of these growth stocks have the valuations they have, but they have the valuations they have. And then there are some value-related names that really look good in paper. And if you're Warren Buffett and you're confident and you're investing for 50 or 100 years, you just park the money there and you just go on with your life. But for people who are trying to see when that validation moment comes, what do you look for? What does that? I mean, is there a group of investors who all of a sudden start targeting Canadian energy names, or do we see acquisitions? I mean, what is the catalyst if the market remains jittery because of the recession worries?
It's going to be arriving at the day when a company announces that we've now reached our final debt target, which is happening actively and in the next several quarters, and say we're announcing a 25% share buyback out of free cash flow.
So they can do it just by the shareholder-friendly stuff that they've already started to do, but you're watching for more on that.
Yeah, our ultimate pleasure point has been deferred by a couple of quarters. Like, it was supposed to be now we've had the drawdown in oil, but you can map in near real time, like the Cenovus and the Suncors and all companies, when they will be reaching their ultimate debt targets. It's Q3 to Q4 roughly of this year, at which point you can say, okay, well, they've already publicly pledged we're going to get 75 to 100% of their free cash flow. You can figure out what that is. Our belief is that a sector will not trade at a 20% free cash flow yield, because ultimately free cash flow and dividends going to be the same thing. And so we think the sector is going to re-rate to a 10% dividend yield. That would suggest a more than doubling in the average energy stock that we see. And so you can't let price set narrative. You can't believe into oil down $1 today. There's not a single reason that you could justify that looking at data. We had a very bullish DOE report yesterday. Global inventories are falling. We're entering into a wickedly bullish scenario where you've got Russian production falling, you've got OPEC cutting production by 1 million barrels per day, just hitting the market now. You've got demand normalizing, you've got China normalizing. So the past doesn't equal the future. This is a story of two very different halves, the first half of this year and the second. We remain very, very bullish entering into the summer.
And yet yesterday, oil was under some pressure because there was a narrative of the inventory picture looking like there was more supply. Like, that was literally how the headlines were popping out. I just want, before I let you go, the White House. There's the political hot potato.
Yeah.
I mean, I don't think it's any secret that if oil, right now, first of all, we're going to have to start talking about elections and this and that over the next year or two. And given the economy is fragile in the United States and prices at the pump is quite a political issue as well, do you pay much attention to those headlines or what they're doing with the strategic reserves?
What they say and what they do are two very, very different things. Why would a politician use very, very scarce tax dollars to go rebuy oil, send the price up, increase inflationary pressures on the Fed, which is, to your point, there's a very strong inverse correlation between gasoline price and presidential approval ratings. We think this is a bit of a red herring. We do not expect any politician to refill that SPR ever again.
Okay.